Stanley Druckenmiller is one of the most successful investors in history and has a track record that speaks for itself. As the former hedge fund manager of Duquesne Capital, he generated an average annual return of over 30% over 30 years, making him one of the most consistently profitable investors of all time. In this video, we'll dive into Druckenmiller's top 5 investing principles so that you can learn from his strategies and apply them to your own investing approach. If you want to apply Druckenmiller's approach to your own investments, be sure to check out the links in the description below for exclusive deals on investment resources. Alright, let's dive into it. Principle 1. Be flexible and adaptable. Druckenmiller believes that being able to adjust your investment approach based on changing market conditions is critical to long-term success. He emphasizes the importance of being open-minded and being willing to change your investment thesis when new information arises. An example of this is when Druckenmiller was managing a fund in the late 1990s and had a bullish view on technology stocks. However, when the market condition began to change in the early 2000s, he quickly realized that his investment thesis was no longer valid, and he changed his strategy accordingly. Instead of sticking to his original bullish view on tech, he began shorting the sector and made significant profits for his fund. This highlights the importance of being open-minded and willing to change your investment thesis when new information arises. As an investor, you can apply this principle by regularly reviewing your investment thesis and being prepared to adjust your strategy if new information arises that challenges your assumptions. It's important to stay flexible and adaptable to changing market conditions and remain humble, knowing that even the most successful investors can be wrong and need to adjust their approach. Principle 2. Focus on risk management. According to Druckenmiller, managing risk is just as important as finding opportunities. He stresses the need to always consider the downside risks and protect capital by limiting losses. For example, during the 2015 to 2016 period, Druckenmiller anticipated that the US dollar would continue to strengthen, leading to a global economic slowdown. As a result, he shifted his portfolio away from riskier assets into safe haven investments, such as gold and US Treasury bonds. And guess what? He was right. His sharp foresight helped him stay ahead of the curve and make profitable investment decisions. This highlights Druckenmiller's focus on risk management and his ability to anticipate and navigate potential market risks. One way to apply Druckenmiller's focus on risk management to your own investment strategy is to regularly evaluate your portfolio and consider potential downside risks. This means being aware of the risks associated with each investment and having a plan in place to limit losses and protect your capital, especially during market volatility. By focusing on risk management, you can help assure that your investments are protected even in the face of unexpected market events. Principle 3. Conduct rigorous research. Druckenmiller stresses the importance of conducting in-depth research on companies and industries before investing. He believes that having a strong understanding of a company's fundamentals is essential to identifying potential investment opportunities. A potential example of Druckenmiller's emphasis on conducting rigorous research can be seen in his investment in Microsoft in the 1990s. Despite skepticism from other investors at the time, Druckenmiller conducted extensive research on the company's competitive advantage and future growth potential. This led him to make a significant investment in Microsoft, which turned out to be a profitable move. To apply this principle to your own investment strategy, you should take the time to thoroughly research any potential investment opportunity. This may include analyzing a company's financial statements, understanding the competitive landscape, and keeping up to date with industry trends. By conducting rigorous research, investors can make informed decisions and potentially avoid costly mistakes. Principle 4. Take advantage of market inefficiencies. Druckenmiller looks for market inefficiencies that can create opportunities for outsized returns. His ability to analyze market trends and identify situations where market pricing may be inaccurate or undervalued has allowed him to make several strategic investments that has generated outsized returns. One example of Druckenmiller's successful application of this principle was his trade against the British pound in the early 1990s. At the time, the Bank of England was trying to maintain a fixed exchange rate between the pound and other European currencies. However, Druckenmiller recognized that the market was underestimating the economic challenges faced by the UK and the potential for the pound to be devalued. He shorted the pound, and betting that it would drop in value, he made a profit of over $1 million when the Bank of England was forced to devalue the currency. This highlights Druckenmiller's ability to identify market inefficiencies and capitalize on them through careful analysis and strategic investments. By staying alert and taking advantage of these opportunities, investors can potentially generate significant returns and achieve long-term success. As an investor, it's important to remain diligent and be willing to dig deeper to identify potential market inefficiencies and undervalued assets that others may have overlooked. Principle 5. Have some patience. Druckenmiller believes that successful investing requires patience and discipline. He is willing to wait for the right opportunities to come along and is not afraid to sit on the sidelines when there are no compelling investments to be made. He believes that avoiding the temptation to make impulsive trades is key to achieving long-term success. For instance, during the great financial crisis of 2007 and 2008, Druckenmiller saw the opportunity to invest in distressed stocks, such as Google and Visa, that were trading at a significant discount. Instead of jumping on too early, he waited patiently for the right moment to buy in. And when he did, he generated substantial profits for his fund. These investments proved to be successful, with his fund generating a return of over 30% in 2009. His disciplined approach to investing and willingness to wait for the right opportunities to present themselves has paid off hugely in the long run. Patience is a critical element in successful investing. Taking the time to research and analyze potential investments before making a move is essential to avoid costly mistakes. Moreover, waiting for the right moment to buy or sell can make the difference between making a profitable investment and losing one. In conclusion, Stanley Druckenmiller's investment principles highlights the importance of flexibility, risk management, research, market efficiencies, and patience in achieving long-term investment success. By being adaptable, considering downside risks, conducting rigorous research, taking advantage of market inefficiencies, and maintaining discipline, investors can increase their chances of success and navigate the ever-changing financial landscape. Druckenmiller's principles serve as a valuable guide to both novice and experienced investors looking to improve their investment strategies and achieve their financial goals. To learn more about how you can secure your financial future, check out the next video popping up on your screen right now.